Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 11th February 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Shan Husain, Vice President of FI FX Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hello, Derek, and welcome to the podcast.
Thanks, Shan.
Well, it's nice to have you here. Let's dive straight into it. What a week we've had. So we've had yet another upside inflation print in the US. What followed in rates was, as expected, more tightening was priced. But in FX, the response was less predictable. What is going on with the US dollar at the moment? It doesn't seem to be performing as well as you would expect.
That's true, Shan. Yeah, no, it's definitely been an interesting week. And I think in particular towards the end of the week post the CPI print, as you said, the rates market pretty much as you'd expect, maybe an even more brutal move at the short end of the curve than what the markets were expecting. So, we had a 21 basis point increase in the 2-year yield in the US. That's the biggest one-day increase since May 2009. So, the first kind of phase of recovery after the global financial crisis started and the Fed implemented quantitative easing, and we had that big jump. So it's really of that magnitude, the move that we've had at the short end of the curve, and of course helped by James Bullard's comments in relation to a possible 50 basis point rate hike as being a feasible scenario for the FOMC meeting on the 16th of March. But the US dollar is struggling for sure. And I'll have to be honest, and I spoke to a number of people yesterday, and there was a lot of people kind of humming and hawing and not completely sure as to why the dollar kind of sold off pretty sharply. I think there's an element of the FX markets becoming a bit wary of buying the US dollar into a circumstance where there's evidence of the Fed possibly being behind the curve. This obviously talk of more aggressive rate hikes. There's also speculation, by the way, this afternoon of an inter-meeting rate hike. Now, there is a regular board meeting on Monday to discuss the discount rate. Now, those meetings are regularly held, but the markets are kind of putting two and two together, and given the fact that the board are meeting, there might be something from that. I don't think that's the case. There is a small chance potentially that they could raise the discount rate ahead of what they're going to be doing with the policy rate at the meeting on the 16th of March. So, this kind of inter-meeting speculation as well is kind of front and focus. And it is just kind of reinforcing this idea of the Fed being behind the curve. And that, I think, is kind of dampening enthusiasm for buying the dollar on the kind of traditional rate spread moves. And, the 2s, 10s curve has now flattened. It flattened, 13 basis points yesterday, and it's down to 45 basis points. And just as a comparison, at the same point before the first rate hike in the last tightening cycle in 2015, the 2s, 10s was trading at about 145 basis points. So, 100 basis points flatter at the same point going into that first rate hike on the 16th of March. And, that tells you that investors are positioning for a more aggressive tightening cycle that ultimately results in this economic expansion period being very, very short. And again, I think that's just curtailing some enthusiasm for the US dollar, I think. And of course, as I've said on this podcast in previous weeks, leveraged funds are very aggressively long the US dollar already. And therefore, looking at struggles for the dollar, you have to remember that positioning in the leveraged fund sector is already aggressively low. I think another point is that the 2-year move, that 21 basis point move, obviously the 2-year spread is compellingly favoring the US dollar from a traditional spread FX perspective. But when you look further out the curve, for example, at the 10-year, the 10-year spreads across G10 have not moved anything like as aggressively as the spreads at the short end favor of the dollar. And a good example of that is the key one in DXY and FX volume terms, and that of course is for euro dollar. And core 10-year yield spreads versus the United States around, just looking at my screen, 175 basis points, and that's essentially in a range that we've been in. 175 upside 200, downside 160, that we've been in most of the period since last September, when the short end of the curve started to move considerably higher. So, 10-year spreads are also important, and maybe there's just a little bit more focus on that spread at the moment, given those concerns about the flattening of the yield curve in the US and the implications of a shorter expansion period going forward. So, there are a number of reasons, I guess. You could make the same arguments in other countries. So, I do expect we're going to see swings back and forth. But as we've been saying for a considerable period of time, this tightening cycle is going to be different in that it's going to be a lot more synchronized. And therefore, the scope for the US dollar to strengthen considerably is much more limited. And of course, since the ECB has shifted to a more hawkish bias, it again kind of takes some of the impetus out of the potential dollar strength on Fed tightening going forward.
Yeah, that's very interesting indeed. And are there any other highlights from this week and for the week ahead?
Yeah, I think, given what I've just spoken about, of course, that's got all the attention, but there was a very significant announcement from the BOJ, and that is the confirmation of a fixed rate unlimited purchase plan of 10-year JGBs for next week, for Monday. It was a holiday in Japan today, but that was pre-announced yesterday. And certainly a notable announcement, because Governor Kuroda spoke yesterday before this announcement, and he made some pretty explicit comments. He confirmed basically that there would not be any hawkish policy shift from the BOJ through the remainder of his term, which expires in April 2023. So markets didn't really kind of respond to that. And indeed, the 10-year JGB yield is being pulled higher because of what's been happening globally. And the 10-year JGB yield hit 23 basis points after Governor Kuroda's comments. And then came this announcement of an unlimited purchase program for JGBs on Monday. So, we'll see the response in the domestic markets on Monday, but certainly from an FX perspective, it has put to bed the kind of intermittent speculation that has persisted over the last month or two that the BOJ was going to follow other central banks and express concern about inflation and potentially end its yield curve control policy. Clearly, the yield curve control policy is not ending, and the curve is already steepening. So the idea that ending yield curve control would steepen the yield curve, and that's what the BOJ wants, well, it's happening already, and they clearly want to keep control of yields because, let's not forget, the inflation story is entirely different in Japan, and I just have not understood the kind of market speculation of the BOJ following other central banks, because it's so obvious that the inflation story is different. Sure, inflation's picking up, but it's more energy related than anywhere else, even the Eurozone. And then the core CPI excluding fresh food, but also excluding energy. That's expected in January to drop to -1%. So, underlying price pressures are still very, very weak. And, the BOJ now have come out and confirmed this ultra loose policy is going to continue. Now, that's the first time they're going to do that unlimited purchase plan since 2018. Back in 2018, inflation was higher in Japan. That core rate was positive, and the Fed were raising rates in the last cycle. And after that unlimited purchase program in 2018, the BOJ did adjust its interest rate acceptance range higher. So I'm not ruling out they could do that at a later date, but I think the clear message is the BOJ is not following other G10 central banks or indeed emerging market central banks, and therefore should be viewed differently. So I think it does open up the scope for yen weakness, but the problem is that dollar yen is at elevated levels, as we've said before, and if we're now entering more volatile financial market conditions, and if equity markets were to fall further because of the Fed tightening cycle, it makes for a challenging move. But there is a window there potentially. If financial market conditions stabilize, if equity markets don't fall, notably, we could see that divergence play into another kind of leg higher for dollar yen. As I've mentioned before, 117 is a very important technical resistance point. And if that breaks, we could see some short-term sharp selling of the yen. So that's something to watch out for. Other than that, very quickly, we've got inflation and wage data from the UK next week. We've had Hugh Pill talk about, a steady-handed approach to tightening going forward and trying to kind of rein back some of the pricing in of aggressive rate hikes by the Bank of England. Next week will be important, obviously the inflation print, but also wages. Wages should decelerate. That's the expectation for the month of December. And that would certainly help reinforce the guidance that Hugh Pill has tried to give to the markets, although expectations have continued to move higher. So that will be key for sterling, and will likely create some volatility for FX pound next week.
Certainly, a lot to look forward to. And what about research trade ideas? Given what's going on, have you updated them?
Yeah, I'll have to admit to our listeners that it hasn't been easy, and some of our trade ideas have gone against us, and we've had to close them out. And these kind of unpredictable price moves for the dollar in particular, it's been tough. So we had a dollar South African rand, long dollar South African rand position just on the basis of what the Fed is doing, and that ultimately would lead to emerging market weakness, in particular those yield-sensitive emerging market currencies like the South African rand. But that's gone against us, despite what's happened with US rates this week. So we've closed out of that. We still have our long euro Swiss franc. Again, higher yields is certainly consistent with a move higher in euro Swiss. It's followed euro dollar, and there is potential for euro Swiss to grind higher now, in particular with 10-year yields across core Europe now well in positive territory. The obvious risk to our euro Swiss trade idea is, of course, Russia-Ukraine. A little bit nervous of that again today. Dollar Russia has jumped. Partly the market was expecting a more aggressive rate hike from the central bank, but also, geopolitical tensions remain elevated, and there's been reports of increased movement of troops on the close to the Ukrainian border. So elevated geopolitical risk. Certainly, if that was to deteriorate, then I think the Swiss franc would outperform. But we'll hold on to that, given the broader kind of macro market views that we have, and assuming, of course, that we don't see any kind of actual invasion from Russia. And then we've put on a long stocky long Norwegian krona versus the Swedish krona, and that's a reflection of the Riksbank meeting that took place this week. And contrary to speculation, the Riksbank maintained its dovish stance and maintained its plan for reinvestments to keep the balance sheet stable. It was a close vote, 4-3. So, that could change in coming meetings, but nonetheless, for the moment, again, the Riksbank, like the BOJ, has kind of, been more aggressive in maintaining a dovish stance, and that should certainly kind of feed into Swedish krona underperformance going forward.
Thank you, Derek, and we wish everyone a great week ahead.
Thank you, Shan, and have a good week yourself. Thanks.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.